Well, welcome to our second quarter 2026 economic update. As usual, last quarter wasn't boring. We hope to give you a general overview of the key issues impacting the U.S. and global economies. We're focusing on the areas that will impact most of our attendees. Please note your questions in the chat box, and there will be ample opportunity at the latter part of the presentation to answer them. Several of you have submitted questions in advance, and we'll address those when we begin the question portion of the presentation. So let's review a quarter when I think we got, as usual, more questions than answers. Joining me today is my partner, Shawn McCabe. Together, he and I will strive to help you make some sense of the economy and the market. Shawn, help us out.
Hey, good morning. Good morning, Marshall. Good morning, everybody on the call. Thanks for the intro, Marshall. What an exciting time since our last quarterly update, as you said. We've seen the shock and awe of the largest IPO of all time, which I know Marshall's going to talk about, the Iran war and higher oil prices, which I'll touch on, a new Fed chair. Unfortunately, as always, Fed chairs are in no-win situations. Elevated and volatile U.S. stock market, of course, improved labor markets, and continued expansion in U.S. and global economies. Albeit the print this morning wasn't as exciting as it could have been, but it's still growth. We'll talk about that. As usual, Marshall and I are here today to help cut through all the noise and, like Marshall said, help you make sense of it. Hopefully provide a little insight on what you should be doing to navigate it. Marshall?
Thanks, Shawn. As many of you know, I periodically assist as a resource for mainstream media, even though I tease and poke fun at them quite a bit. I serve as a financial professional resource for them. They frequently refer to days when there's only one major story and everything else tends to take a back seat. This quarter, once again, somewhat measures up to that scenario. The story, of course, is the war in Iran and its domino effect on oil prices and thus the various world economies. And you might recall, as Shawn mentioned, there was an initial public offering, an IPO for SpaceX. With a SpaceX IPO, it became quite apparent that many investors don't clearly understand how IPOs work. There are several AI-related IPOs scheduled in the coming months. So I'll present an anatomy of an IPO to assist you. Wow, we actually have two stories this quarter. Shawn and I will do our best to help you make sense of it all. So let's dive in. But first, there's this shift in the focus of the most significant companies receiving the headlines. So I'm going to talk a little bit about FANGs, Magnificent Seven, and mangoes. Sounds like a little bit of a fruit thing, or watch out for snakes in the fruit. You may recall not so many quarters ago, the securities receiving the headlines were the FANGs: Facebook, Amazon, Apple, Netflix, and Google. If you held these companies, you were getting significant returns. You were loving your portfolio. Lo and behold, the FANGs evolved into the Magnificent Seven, most of which for 2026 haven't been very magnificent. Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla, when we look at how they're doing this year, the year-to-date performance significantly lags the S&P 500, and especially the remaining 493 companies in the S&P 500. As you see, the Magnificent Seven's return is less than half of the other 493 companies. The negative returns range from the biggest loser, Tesla, at a negative 33%. So they're down a third from where they were beginning of the year, to Apple with a 26% return year to date. Now, I know you're thinking, wow, but what about the numbers today? You're right. Market's really looking favorable on some of the Magnificent Seven today, but they weren't yesterday at 359. So you stay tuned from day to day, but you only have two of the seven positions in positive territory for 2026. Four are down and Amazon is flat. Kind of interesting. So Marshall, what are mangoes? It's a great fruit, makes a wonderful adult beverage if you throw some good stuff in there. But the mangoes are what we're looking forward to. Meta, Facebook. Well, let's talk about Facebook, and let's face it, we all know Facebook and Instagram. Anthropic. It's an artificial intelligence company headquartered in San Francisco, California. It's developed a large series of language models called Claude and has a focus on AI safety. Anthropic was founded in 2021 by former members of OpenAI. Going to talk about that in a minute. The company's privately held, has an estimated value of $965 billion. That's even bigger than Shawn's checkbook, making it the most valuable pure play AI company in the world. It has confidentially filed a US IPO for listing later this year. NVIDIA, inventor of the GPU, the graphics processing unit, which creates interactive graphics on laptops, workstations, mobile devices, notebooks, PCs, etc. Of course, NVIDIA had been a darling for quite a while, but it's kind of stagnant for 2026. Google, Alphabet, we all know you can't function on a daily basis without Google. The term for searching has become synonymous with Google. It's out there. I mentioned OpenAI. OpenAI is an American artificial intelligence research organization, also headquartered in San Francisco. It consists of the OpenAI Group, a for-profit public benefit corporation, partially controlled by the OpenAI Foundation, a not-for-profit. Now, how's that for being convoluted? OpenAI developed the Generative Pre-trained Transformer, GPT, family of large language models. Got all kinds of developments going out there. It released ChatGPT, something you may be familiar with or may use, in November of 22, and has been credited with really opening the AI boom. There's widespread interest in it, and it too has filed a confidential US initial public offering. They filed the paperwork on that, but that's anticipated for either late fall or early spring next year. And then, of course, we have SpaceX, Space Exploration Technologies Corporation. Was a private American spaceflight, telecommunications through Starlink, and artificial intelligence company, and probably has received more press than any company I can imagine in history. Been in this business a long time, and I've never seen an IPO that got so much attention. Let me give you my little caveat here. While I may make references to the SpaceX IPO, please do not interpret my comments as they are intended for exemplary information, not as a recommendation to buy or sell SpaceX. One of the main reasons a company goes public is very simple: to raise substantial funds in a private offering that private financing just can't provide. By issuing shares through an IPO, companies can tap in to public markets, attracting institutional investors such as pension funds, mutual funds, insurance companies, as well, of course, as the retail investor. Going public provides liquidity for early investors and employees who hold equity in the company. Private shares are often illiquid, making it difficult to convert ownership into cash. A public listing allows those stakeholders to sell shares in the open market, diversify their holdings, and implement tax-efficient strategies. Aha, here we come in as financial advisors. Employee stock options also become more valuable, offering a tangible financial reward for their contributions. Public companies gain flexibility for future financing. They can issue additional shares. They can go out and borrow public debt. It just strengthens the company's governance, reporting standards, and that improves operational efficiency and investor confidence. For some companies, going public is part of the long-term growth strategy, enabling them to schedule more rapidly and compete on a larger scale. In summary, companies go public to unlock capital, provide liquidity, enhance visibility, support growth, and offer employees and early investors a way to realize the value of their investment. But now what happens mechanically? Keep in mind the initial private, okay, even though it's still a P, private offering and rounds of investing took place years ago. For example, back in 2015, Alphabet, the parent of Google and Instagram, and Fidelity Investments invested $1 billion for a 10% stake in SpaceX. That would put the company value at under $12 billion. Since 2015, there were additional rounds of investments, mergers, et cetera, that diluted Google's ownership down to about 5%. That position is up about 12,000% in 11 years. Not too shabby. So we fast forward to 2026 and the IPO. When the IPO came out back last month, gosh, that's hard to believe. It's only been that long. Only about 5% of the total stock was available to trade in the IPO date. My understanding, it was 4 times oversubscribed, or some of the numbers that we hear. After the first 15-day restriction is lifted, more shares were available to trade. Starting at day 60, which will come up next month, shares start getting released in tranches. Roughly 7% of the remaining shares are released weekly for possible trading. So that takes about 15 weeks before you get shares that are out there. At about 6 months, shares that are held by most insiders are released for trading. And after the first year, shares held by key insiders are released for possible trading. So if you're Elon Musk, you're obviously a key insider, and therefore Elon can't trade his shares for 1 year. If you're a chief executive inside the company, you have inside information in the company, you can't trade for at least 6 months. So it gets kind of interesting. So how does this impact the stock price? Well, the hype is greatest at the initial date and for a couple of weeks. The number of shares available for trade is at its very, very minimum. As restrictions expire over the initial months, more shares come available for trading. I want to harp on for just a minute. You may have seen there was a lot of press about the welder who worked for SpaceX, blue collar worker, and suddenly, because of the shares that he had been granted over the years he'd been working there, he had a net worth of over $4 million, or he had an investment in SpaceX of over $4 million. He couldn't trade them yet, and he may still not be able to, depends on where his tranche comes up. And so that can be a real challenge for him, is that, yeah, I've got this value, but I can't do anything with it until I'm eligible to trade. Now, I want to fall off of SpaceX for just a minute and talk about other significant IPOs, and then I'll come back. These are some of the IPOs, 10 as a matter of fact, who have been getting the tremendous amount of press. Now, literally, there are thousands of IPOs that have taken place in the last 25, 26 years. But here are 10 that are real significant and got a lot of press. And as you can see, when you look at their value 1 year later, they're all down. The average of these, they're down 27% from the IPO. Well, why is that? You have the hype of the initial price and you have the value of the initial price. So you have to watch the price. You have to watch what you're really buying. Now, while we're months away from the 1 year anniversary of the SpaceX IPO, the stock has traded between a high of $225 per share and a low of $107 per share. Sorry, that's a little bit too volatile for my blood. Enough on SpaceX. From a larger view, the market's still batting 1,000 through every global, domestic, and economic crisis. It has still recovered and gone on to new highs. Shawn, enough about IPOs. Give us some energy to talk about.
Energy is always a good topic. Marshall, you and I have been tracking oil closely this quarter, actually since the beginning of the year, and it's kind of hard not to. I'm not sure if you remember, but at our annual update in January, we discussed how energy could be the catalyst that could slow the economy and markets this year. The good news is, so far, the markets seem to have shrugged off higher oil prices and the volatile energy prices that we're seeing in the headlines. They may not stay the case. The longer the Iran war goes without complete resolution, or at least a strategy for bypassing the Strait of Hormuz, we'll just have to wait and see. So let's dive a little bit into what's going on here. Currently, we're seeing West Texas Intermediate WTI at around $83 a barrel. I checked at about 7 this morning. and Brent is trading around 90 a barrel. WTI peaked at around 120, Brent around 126, sometime, I think it was late April or May or June. As mentioned earlier, though, the markets have mostly shaken this off, and I'm going to show you a slide later and explain why we think that's the case. Initial inflation measures are starting to see the impact. We'll show you that too. But in the same breath, you'll see why we think consumers don't care about it, at least for not right now. Considering WTI, West Texas Intermediate, prices are primarily driven by U.S. inventory logistics. Generally, whatever data and news come out of Cushing, Oklahoma, drives that price. It's the primary delivery point of WTI. And whereas Brent, which accounts for 2/3 of the world's global oil supply, is mostly extracted offshore from the North Sea, which makes it incredibly sensitive to, you guessed it, international disruptions like tolling, terrorism, and choke points, as in the case with the Strait of Hormuz. Hence all the attention around what's going on with the war in Iran lately. So let's refine this a little bit. Like what I did there? Anyway.
That was cute. I like that.
What matters most to us, though, are really two things, I think. The price at the pump as a leading indicator to the economy and how it impacts our portfolios. So first, the price at the pump, and I'm heuristically speaking here, just let's keep it simple. It's a little more complex than this, but the price of the pump is what drives up costs for producers, right? There's higher fuel costs, costs them more to transport, sometimes more to produce. And a lot of times they pass those higher prices on to consumers. Second, higher fuel prices, like the rest of us, means less cash in our pockets to spend on things. And my not quite so $1 billion checkbook, Marshall, is starting to feel that pinch on the fuel price since I switched over from EV. So unless you drive an EV, you know fuel prices hit about $4.50 per gallon back in May. For now, the price at the pump has settled back down to around $3.69 today. And if you're in Jacksonville, the Circle K over on Roosevelt has it at $3.69. So you may want to go check that out. For now, though, all indications are that higher fuel prices are directly correlated. And Marshall, I don't know if you agree with this, but directly coordinated to the news related. And let me rephrase that. They are directly correlated to the news related to the events out of the Strait of Hormuz. As soon as resolutions are figured out there, prices will fall back to the normal $60 a barrel, we hope. And we should see prices at the pump come back in check. Kind of an sidebar here, and I've kind of thought about this myself and do a little research on it, but we see the volatility in fuel prices, and everyone thinks about the fuel at the pump and how come the price at the pump isn't coming down. Well, if you owned a gas station and you haven't made your next order for fuel yet, and the price is swinging every single day, higher or lower, you're not going to budge. You're going to wait and let things settle down. So even the producers of fuel, right, the guys that are selling us and dispensing the fuel, don't know what to do. So, but in general, though, the world seems optimistic for the resolution, for the settling down the Strait of Hormuz. Consumers are still spending. I'll show you the numbers in a minute. Producers are absorbing the increased costs for now, which is why I think we haven't seen too much of an inflation spike over the last quarter. And I think why the Fed, amongst other things, has kind of stayed the course so far. So we'll continue to keep a close eye on oil. No need to track the ships making it through the strait. But if you are curious, pre-conflict saw about 60 ships per day, and currently they're about 15. Maybe we eked up to 16, maybe back down to 14 overnight with all the issues going on. But I encourage you not to watch it that closely. It'll drive you nuts, trust me. All right, let's move on to the general economy. So next up are what we like to call the big four. Yes, we are nerdy CPAs at times. I'm referring to economic indicators as the big four. They're more important to us anyway. So first up is real GDP, inflation adjusted gross domestic product. This is the most common metric, in my opinion, for how our economy is growing. And it does represent what the annualized growth rate would be over the previous quarter or year. GDP was reported less than 2 hours ago, 8:30 this morning, so we're right at about 2 hours, and it printed at 1.5%, signaling a little bit of a slowdown from last quarter, which we had growth of 2.1%. But keep in mind, the economy is still growing, just at a slower rate. To make the most out of GDP or any metric, frankly, you kind of have to pop the hood. You got to see what's underlying that metric, what's it made up of, to kind of make sense of it. And we go to the Bureau of Economic Analysis to get that data. They finally got it out on time, so we're able to get the most up-to-date chart this morning for you. But the contributions for growth this quarter were similar to Q1, believe it or not. But and it was driven mostly by consumer spending. That's the blue bar to the right of the orange bar. I know the slide's kind of hard to see sometimes. Again, driven mostly by consumer spending. And the next biggest push for the increase in GDP this quarter was business fixed investment. Who would have thought, right? All the money that's going back in the AI and these tech companies reinvesting in that is pushing up our GDP. And then exports were the last little contributing factor there. And then the primary difference from Q1, though, is a reduction in government spending this quarter. Last quarter, government spending actually contributed to GDP. So all things being equal, not exactly great news that growth wasn't a little bit stronger, but it's also not bad news. And particularly not bad news because it's primarily driven through or by consumer spending. And we'll tie that together here in a second. So jumping into the inflation as measured by the consumer price index, which I always like to kind of cover what these things mean for some of the new folks on here. CPI measures the average change over time in the prices consumers pay for a standard basket of goods and services. Think fuel, food, housing, transportation, and so on. The latest measure came in at 3.5%. That's as of June 26, of course, which was an increase or is an increase from the 25 measure. So we've seen 3.5% inflation year over year. And that's signaling a slighter hotter economy than what the Fed likes to see. The Fed's ultimate goal is inflation in check, which means at 2%. So they have their dual mandate, right? Max unemployment and inflation in check at 2%. So seeing it at about 3.5 for the quarter is kind of like, okay, not too bad, not too far off, but it's a little higher than where the Fed wants it. And then when you measure that 3.5 this quarter to the historical inflation for our country from 1914, measured from 1914 to 25, runs about 3.2. So we're not that far off, believe it or not, in normal year-over-year inflation increases. So I would say that yesterday's no change decision from the Fed, it kind of makes sense. There's not that much pressure on inflation. And you may be thinking, Shawn, you're crazy. Like fuel prices and food and all this other stuff. If you're thinking that, I'm about to address it. Just like the importance of understanding the makeup of GDP, we like to assess the makeup of inflation. The story has largely remained the same since last quarter. Know this chart has a lot of data points on it. I just want to focus your eyes to the 3 bars to the full right. That's the last 3 months that shows this quarter. The colors are the different pieces that make up inflation, okay? And energy prices have gone up, which is the little green section of that bar. And surprisingly, so is consumer spending, which is what color am I looking at here? I think it's the blue bar that's part of that, the light blue bar in the middle. This correlation is interesting to me because higher fuel costs have not impacted consumer spending yet, if you think about it, which is why we're saying consumers are shrugging off higher energy costs, at least with their wallets. So time will tell eventually if fuel prices don't come down, us consumers are going to feel it. We're like, man, it costs twice as much to travel around all this stuff, and cash will run out eventually, and producers will be forced to pass those costs on to consumers. Right now, producers are absorbing that cost, so we're not feeling it in the consumer spending side, at least for now. So we'll see what happens. That's the best answer there. Moving on to unemployment, it has decreased slightly since last quarter, so only 4.2% of the total labor force remains jobless. I mean, it would be nice to see 100%, employment, but it's never going to be the case. Historically, our help wanted or our unemployment runs around 6.25, so we're well below the historical average. And to me, the trend is moving in the right direction. We're at a decent unemployment. When people are employed, it means people are spending, and when people are spending, it means more momentum for the economy, GDP, and the markets and stock market. So again, with the Fed's goal of maximum unemployment, you start tying all these pieces together. GDP, okay, we're not growing as much. Inflation, yep, it's still it ticked up a little bit. Okay, we're starting to see that. Consumers are still spending, and the thought in the back of all of our minds with the Strait of Hormuz and oil being kind of high, maybe it's temporary, and I hate the word transitory. You got used so much during COVID, but is it transitory? And if it is, we don't want to overreact. And that's the whole point, I think, why the Fed stayed flat this quarter. So speaking of the Fed, moving into the Fed funds rate, we talked about the dual mandate, right? 2% inflation and maximum employment. It makes sense why the Fed maintained their position, in my opinion. There was only 3 governors that dissented against the decision out of 12, and the current effective rate is still sitting at 3.63%. Not bad. During Chairman Warsh's June Fed meeting, he had stated, this is a change from Chairman Powell to Chairman Warsh. Chairman Warsh had stated, forward guidance, and I quote, is not well suited for the current policy conjecture. And that makes sense to me, right? There's so many variabilities for him to give forward guidance on, hey, where's the rates going to be 6 months from now? No, he doesn't know. Nobody knows. Chairman Powell said it a bunch of times. He didn't know. So Chairman Warsh is basically doing away with forward guidance. However, this dot plot, something that we do look at, is technically forward guidance, right? It takes the votes of all the governors and says, hey, where do you think rates are going to be, or where do you want them to be in 26, 27, 28? And then obviously the average longer term run. The latest dot plot we have is from June, so from the last quarter. So we published the same one. And if you look at it, the blue dots are all concentrated right around that 3.5, 3.75. Yeah, there's some governors that want to see a little higher, some governors want to see it lower, but argumentatively, we're looking somewhere right at 3.5 as an average on all those dots. If you just look at it, you can tell. So as the Fed does continue, they did say, I read an article that they did say they are going to continue publishing this dot plot. It may not be as timely. We're not sure exactly when, but again, we'll keep an eye on it. It's just a forward indicator of what the sentiment of the Fed governors are and where they're thinking things are going to go. So that essentially does it for all the big 4 indicators. Let's zoom out a little bit. We're going to look at the LEI, leading economic index, measures 10 components of data, not just my big 4, right? And our big 4, if you will, to help determine the direction of the economy. LEI turned slightly positive since we checked on it in March, suggesting the economy may be stabilizing after some weakness since December. While one measure doesn't establish a new trend, it's kind of nice to see we're moving a little bit further away from recession risk, and we're starting to see things moderate. So that really does do it for the data. Let's shift over to what consumers are saying. How are we feeling? So we've been talking about oil and inflation and how it feels so bad, but yet the data that we're looking at says things are great. Maybe not great, but things are pretty good. So before we dive into consumer sentiment, I want to address that. I'd like to pause and address why many consumers are having those different viewpoints in the economy. It makes sense when you look at it about what I'm about to funnel it through for you. So there's a relatively new term known as K-shaped economy, and it was made popular during COVID. There was a lot of disparity in economic views back then. We shut the economy down and watch what happened. It was the craziest experiment of all time. And before I get too much down the path of I plead the fifth, we're not going to go there. So never mind, I'll get back on track here. To me, it's just a new term of the age-old debate related to middle-class America. The K-shaped economy is the age-old debate of what middle-class America does. That being said, we anecdotally refer to the division as special K and not so special K, where the folks experiencing special K are benefiting from the increased stock market prices, increasing dividends that they're getting from their good stocks there, increase in wages, higher savings, they're traveling more, vacationing more. They're the consumers that are spending, and these folks feel great. On the other side, the folks that are experiencing the not so special K economy are struggling with increased food and fuel costs, SNAP cuts, the benefits from the government cuts, increasing credit card debt. We're seeing it across the board. And generally, these folks feel not so great, feel like the economy is terrible. But to reconcile this, think about the Pareto principle. And that's the 80-20 rule we all kind of throw around for all things. There's a lot to it. It's not a law. That's why it's a principle. But where special K in this situation, anecdotally, 20% of the populace is truly driving 80% of the economy. And the inverse is true as well. 80% of the populace is contributing to 20% of the economy. So while we are hearing a lot about the squeeze and inflation and how bad it is out there, it is for some people, right? And at the same time, the data says everything is just peachy, and it is for some people. The economy and markets will continue to do well if the special K group continues to feel good and spend, because the economy is driven, 7% of GDP is driven by consumer spending. So I hope that helps kind of reconcile the difference between the data and what's going on. And the consumer confidence is rising. And this is a pretty good indicator of how people feel. So I'm gonna dive into this a little bit. We often look at the consumer confidence index to check in on how consumers are feeling, right? It does tie to the other data points. It can provide a potential insight on where the economy is heading. Remember, though, consumer spending drives 70% of the economy, which is why this indicator has merit. It's not always perfect. It's not, we can't predict things with it. It just gives us a sense of, when tying it to other indicators, what's going on? How are people feeling? What does this data say? And to kind of put some perspective on it, 100, a print of 100 in this index is thought of as a neutral outlook. It's lower than that because that 100 was based on a 1985 study. So whatever. Let's just keep it at 100. So below 100 is generally viewed as negative, and above 100 is positive. So we don't get overly concerned until we see this index sink several points at one time, or it drops really low, like below 80. It's not really low for some people, but in this instance it is. So when either of those, because an 80 is passing most exams anyway, when either of those occur, it could signal consumer behavior is changing a little bit before that it shows up in data, right? Because GDP is not going to show a drop in consumer spending unless people start feeling bad and stop spending. All right. But that's being said, with an index reading of 92.2, which is where we are today, or as of June 30th, consumers feel better than they did last quarter, which was 91.8. And to me, that ties out to the consumer spending and the relation of consumer spending to the inflation. Consumers are starting to feel better. They're spending more. And I'm pretty sure gas prices and the higher cost of groceries that stuck around is still causing some resistance from it moving even higher, but we are moving in the right direction. All right. So just as a fun aside, the last time the indicator was over 100 was in December of 2024, where it read 109.5. Now, this indicator does come out monthly, so there's some variation. We only check in on it once a quarter to present it to you guys. But I'll let you think back to what was going on in 2024 and kind of decide what's going on there. So I have a little fun with AI. It's all the buzz. Marshall was just talking about AI and all the IPOs that are coming out. We see it in the inflation numbers. People are investing in it. Big businesses are investing in it. It's adding to GDP. So I'm gonna play with it. So I plugged our big four indicators into AI and asked it to give me an image. Just, hey, give me an image on, if I plug these indicators in, what do you think about the markets? And if you're looking at this thing while I'm talking, AI did too bad, actually, I think. We're still in a bull market. So you see the bull aggressively standing on the hilltop with the sun behind him. Like, things are all kind of good right now. You can kind of see the trend line, going up and to the right with a big bright spot at the end of the road down there. But somewhere between the bull market and the bright spot, there's a lot of turmoil going on in there. A little compass down the corner. I'm pretty impressed with this thing. It's kind of fun to do. So I like the image, but to round out our economic outlook, here are a couple points. The U.S. economy is really resilient today. Thanks, AI, for telling me. Uncertain tomorrow, always is, but opportunity endures, right? We've got a whole shifting economy with AI like we did in tech. Marshall and I talked about that back in January, about it being a fundamental shift and not just a bubble. If you're curious about that, you can go back and watch our videos. There are plenty of uncertainties that remain. That's always going to be the case. Tariffs, inflation, slower growth perhaps in the U.S., fiscal pressures, the U.S. debt, and of course, geopolitical risks. We have a strong labor market. Consumers are spending. Businesses are investing in innovation, and the markets are doing well. Save you the last couple of days of speculation with the chairman was going to do, but we're seeing an update today. All that to say, I think we can breathe for a little while, enjoy a little of the not much has changed, and enjoy some quietness before the political ads begin. Okay. All right. So that's it for me, Marshall. Speaking of geopolitical risk, I will turn it back over to you, sir.
Thanks, Shawn. I can't think, but there's no song. What the world needs now is love, sweet love. That goes way, way back. And I can pretty much say in geopolitics, that ain't happening. We'll start with the U.S.-Iran conflict. That's what gets the most press. The Hamas versus Israel seems to be holding to the peace accord at the moment. I speak regularly with one of my clients in Israel. He recently told me the concern is more with Iran than with Hamas, but Israel is always on the alert for attack. I think a boring day for them is when they're not attacked several times from different factions. The Russian versus Ukraine conflict continues, but the media is more focused on the activity in Iran. So we don't hear as much about what's going on with Russia and Ukraine. The U.S. and China are in full economic war, although a lot of people don't want to mention that. They're using tariffs, the Iranian oil, but at least they're talking. It seems to be the rhetoric fluctuates almost daily with the US-China relations. So a lot of tense areas globally. I don't see anything that causes this to change through the remaining of the year. There may even be some new components that we didn't foreshadow here in the comments I did last quarter. So all I can tell you on this is very simply to stay tuned and see what happens with the economy. On the US political side, the US government is not partially closed. I thought that would be a better headline because it seems like every quarter we do this, there's some partial closing either occurring or pending or whatever. You may recall that a bill got passed. And how do they get a bill passed? The usual way. They gave away any holdout votes that needed pork for their district or their pet projects. Congress is doing this ad nauseum for decades. It's become the normal course on how you get things done in Washington. The result, of course, is more spending, no real cuts, and an increase in the deficit, or as I like to refer to it, business as usual. Oh, and I'm thrilled to remind you that it's an election year, so we'll have plenty of volatility in Q3 and Q4 this year. Like I did the anatomy of an IPO, I wanted to do the anatomy of the US finances in English. So every quarter I comment on the rampant and unchecked US debt and spending. This quarter I thought I would kind of quantify it in terms that are easier to comprehend. As you can see from the left, there are a lot of zeros. We got the tax revenue, 5.2 trillion. We got federal spending at 7.1 trillion. Wow, that's a lot of money. New debt, then, it takes another 1.9 trillion to fund a new debt, but the national debt's already 39.5 trillion. And through Congress, we have proposed budget cuts of $50 billion. Isn't that awesome? Well, let me bring that down and put that in what an American household would look like. If we get rid of 8 zeros, okay, that would give you an annual family income, tax revenues versus family income of $52,000. But you're spending $71,000, so you got to put new debt of $19,000 on your credit cards. But your credit cards are already at $395,000, but you've had a family meeting and you're going to cut the budget and you're going to cut it by $500. Okay, I realize I'm being a little sarcastic, but the numbers are the numbers. And the question you have to continually ask yourself, if this were your household, how long could you sustain this before things went really, really bad? And keep in mind those credit card balances, when interest rates increase, well, that just means more interest expense. And so those balances go up quicker, the new debt goes up quicker, and it's a spiral going in the wrong direction. Wow, doesn't that make you just feel awesome? But hey, let's talk about everyone's really favorite topic, taxes. Shawn?
I think we should move this slide next time. I don't want to follow that with taxes. I think we're going to run people off.
Go from bad to worse or worse to bad? I'm not sure which way that went.
So I did a quick calculation while you were talking about that, and the total national debt to the national income is a 7.69 debt to income ratio. And I think about that and I go, okay, most family households run a much higher debt to income ratio. So thinking about it, like I like what you did, like you brought it down to, human terms, like we can understand, 5 zeros versus 8. And, what would it take to get out of that? It's a good question, Marshall. I'm glad you brought that up. And I think and I'm sorry, I'm kind of going off a riff here, but I think so as long as the US is the safe and stable currency, it's the global reserve currency, and we have the market size and liquidity, we can get away with it. And in the attractive yields compared to the rest of the world, where is the rest of the world going to go? But man, you're right. We got to do something about it. Anyway, let me bring it back to taxes. Let's move on. We really only have one quick tax update for you, and not a lot has changed since the beginning of the year. There's some new tax law that kicked off July 4th, so maybe a little spoiler there. But before I do that, I want to provide a PSA, public service announcement. And it is, if you love your CPA, and for some of you, you've extended your corporate or individual return, show them you love them by getting them your tax documents sooner than later. Extension deadlines are approaching. So now back to our regularly scheduled program. I had to throw that out there. If you didn't guess it when I said July 4th, I want to talk about the Trump accounts today. I'm going to spew a lot of data at you. Generally speaking, though, if you have a child that could benefit from Trump accounts or one of the other 4 opportunities that we're going to talk about, give us a call. We'll walk you through that. But Trump accounts, formerly known as Section 530A accounts, are new investment vehicles established by OB3, the One Big Beautiful Act. They are designed as tax advantage custodial accounts, kind of like an IRA for children or a child under 18. They do represent a pretty cool and pretty significant shift in government-led savings initiatives over decades. Prior they would give credits for starting plans or do this other stuff. This time they're literally putting $1,000 of government money into the child's account, starting if the child was born between January 1st of 25 and any child born before January 31st, 28. So anyone born in that window will get that initial seed money, but you have to open the account. It's not an automatic kind of thing. The accounts are officially eligible for being open July 4th. That was the date these things are supposed to be started. And the IRS has reported that over 4 million children so far have been enrolled. The pilot program has been successful. The mechanics are very simple. Once the account is established, the seed money goes in. It's on top of the $5,000 that the family can annually contribute after-tax dollars to fund. Okay. These funds will be, they're required to be invested in low cost. There's a cap on how much I think it's BNY and Robinhood teamed up and are managing these accounts. Parents can control the investments that are in them. So it's going to be super low fee. You have to buy pretty much index funds. And it's just a really great way to help our children start building wealth. All right. So just let you know, if you do have questions on that, reach out to us. We'll point you in the right direction. You can add Form 5457 to 4547 to your tax return next year to open it, but it's actually better if you just go to the Trump account website and open the account for the kids. And, yeah, we'll talk
Shawn,
about that.
There's also a Trump account app out there, by the way.
Yes, there is an app you can download. That's a great point, Marshall. Thank you.
Like everything else in life, there's an app for that.
Yeah, for sure. All right. And we would be remiss if we did not discuss the other options. Like I mentioned, while we're on the topic, there are 3 very well-known options and then 1 lesser known we're going to cover today. 529 plans, purpose-built for education. I think a lot of us know what these are. There's some cool tax strategies we can take for gifting and all that. Contributions are made after tax, are tax deferred. Growth potential. Yeah, contributions are after tax, but the growth is deferred and tax-free if it's used for college, period. Some states do offer some tax benefits for contributions. So if you're in a state that has state income tax, it can also help offset that. And assets count. Cool point here is assets count as a parent or the grandparent's assets on the financial aid forms and typically have less than an impact on financial aid eligibility than the child-owned accounts, which I bring that up for the next account that's available to help on our kids in the future. And that's the UGMA, UTMA, Universal Gift or Universal Trust of Minors account. These are custodial accounts. And they basically, it's just an account in the child's name, but has a parent that custodies and has control of it until that child reaches the age of majority, which is basically the word for the legal age that they're able to take and own assets. The cool part about this is it is subject to kiddie tax, whereas the first $1,350 is tax-free. $1,350 is taxed at the child's rate, and any amounts over the $2,700 are taxed at the parent's rate. So you got to kind of pay attention to that if you're going to be building that account for these kids and they start earning a lot of money. It does make taxes a little bit more complex, but not a big deal. Next up is if a child earns income, and I've had a lot of clients lately doing some tax planning with small business. Their child's actually doing work for the business. Big caveat there. And the parents are paying them. They get a great tax deduction. They keep it under the standard deduction window. Kid gets it tax-free, but it's income that the kid can put into a Roth IRA. Super powerful opportunity for kids to start building wealth. And the cool part about IRAs, it's the traditional IRA that was, but the Roth IRA offers powerful long-term growth potential. Contributions, not necessarily earnings, can be withdrawn at any time, tax and penalty free. Qualified withdrawals of earnings after age 59.5 are tax-free, of course. The main condition is that account's been held more than 5 years, but we're talking about the kids, so they're going to hold this thing for a long time. Some exceptions allow you to withdraw earnings from the Roth IRA before 59.5 without penalty. There's a lot to that. We're not going to get into that today. But one of the big things is the first-time home purchase and qualified education expenses. So it's kind of a cool strategy you can work here to help pay for junior's college through funding a Roth IRA, and maybe get some tax deductions along the way. Again, we'll talk about that later. Plus, your contributions to the account can always be withdrawn anytime, tax and penalty free. So cool options there that a lot of people that don't really think about or don't know. Okay. And here's the last one. So it's the less known option, but many institutions offer specialized accounts for youth. These accounts can be incredible opportunities to impart some responsibility on your youngster and help them learn finance. I think that's important. There's not a lot of that teaching going on these days. We all had to learn the hard way for the most part. But for teens who want hands-on experience in managing their own money, Fidelity, one of the brokerages we use, for instance, has what's known as a youth account. And many institutions have these. It's a teen-owned brokerage account that can be opened at age 13 and age 17 at Fidelity, for instance, with a parent or guardian as the linked adult. Unlike the custodial account, the UTMA, UGMA that we talked about, the teens actually make their own investing decisions. While the parent does have visibility, you can coach them, train them, make sure they're not, buying a bunch of Bitcoin, right? I don't know. Teens may also get a debit card on that account, but you need to check the fees. Most of these platforms, they reward this kind of behavior. They want the next generation taught up on finance. So they usually just waive fees. There's no fees for these, but you got to check the institution you're doing it with. I know Fidelity's no fees on these. And again, it's a really great way to teach our kids and let them learn before the stakes are high and they're out on their own. So I'd say this again, if we can help you with any of these strategies we talked about, or what makes sense out of these 4 different new options or 5 options with the Trump account, give us a shout. We'll walk through you. It's not a big deal. All right, so speaking of advice and tips, we'd like to invite you to navigate to our YouTube channel. You can scan that QR code. So we'll leave this here for just a brief second while I'm still talking. You scan that, it'll take you to YouTube. Go ahead and subscribe. If you're unable to register for our next economic update, or you were registered and you missed it, we do send you a link based on your registration. But you can always go back, like I talked about our January update where we were talking about oil and its pricing and all that, and go watch our prior sessions on our YouTube channel. So if you scan that, subscribe, you'll get alerted when we upload new videos. And again, it's really the easiest way to rewatch our quarterly presentations. And I like to joke to say that some nights, if you have trouble sleeping, pop these on, let them flow. You'll be asleep in a heartbeat. So Marshall.
I'm awake at the moment. I've not been watching. I've been presenting. So let's talk about interest rates. You've probably seen some press that a critical driver of the U.S. borrowing costs are the 10-year treasuries. 10-year yield rose slightly last quarter. Remember, this is the key rate for economic certainty and uncertainty and cuts from the Fed. We don't see any significant change in the near term, and that got confirmed yesterday afternoon. The 30-year mortgage rate has also risen. Remember, like the 10-year treasury, key drivers are economic uncertainty and rate cuts from the Fed. A lot of times we get previous questions, seems like every quarter, what's happening, what's happening with real estate and that type of thing. But as long as the 10-year treasury yield isn't dropping and the Fed doesn't resume lowering interest rates, financial institutions are feeling more uncertain because of the war in the economy. They're not going to be dropping rates, and mortgage rates aren't going to be falling. With mortgage rates not falling, then real estate is not going to be heating up. Interestingly enough, I saw a statistic the other day, and there are more than 500,000 more homes for sale than there are buyers out there. So it's switched from being a seller's market to a buyer's market. Kind of, as usual, an uncertain time if you're in the real estate market. But there's always uncertain times, and we have to be certain and uncertain about investing.
Yeah, uncertainty creates excitement, and whether it's good or bad is up to the beholder, I suppose. But Marshall, you bring up a good point about the 10-year treasury and real estate, and you saw that statistic on the number of homes for sale, the increase there. I actually saw it in the Q1 numbers. We don't have it on this slide deck, so no need to slide back or anything. But in Q1, where the contribution to GDP was actually held back by a reduction in the real estate contribution to GDP. So I thought that was interesting. Real estate is definitely slowing down a little bit. Uncertainty, it's here to stay. There are and will always be reasons not to buy, and I'll put in parentheses on my notes here, or to sell when it comes to your portfolio. We cover this topic every quarter. And I'd say for obvious reasons. If you listen to the news, there's always a reason to run the other way. Am I wrong? A lot of talk lately has been about a market top. In the last few days, it kind of, quieted this down some, but we are at market highs. We've been at market highs. Every time the market goes higher, we've hit a new top, right? So let's look at it. Say you invested at the absolute peak of the stock market in 1956, and that's that far left blue bar, okay? Your average return since then would have been 7.5% annually, annualized over that whole period of time, okay? Say you happen to fully invest in your portfolio at the peak in 1980. It's that middlemost blue bar. You would have had roughly a 9.2% average return since then, okay? And we're talking 9.2% linearly averaging every year over year since 1980 to now. That's what, a 46-year return, getting an average of 9.2%. That's pretty good. So let's just say you have the absolute worst timing for investing, which none of us would, right? None of us could ever have to absolutely have the best timing, right? Otherwise, we wouldn't live here. We'd be as rich as Elon Musk and have that $1 billion portfolio. But get back to the point here, and you bought in only at every peak, every one of those blue bars is the only time you invest in the market from 1950 through today, or through 2022. That's where these numbers come from. Your average return, the reward you got for investing at the absolute wrong time in history, would still have been an average of around 8% annualized over that whole period. So my point here is it may seem simple, right? But it is nuanced. It doesn't matter when you invest. So don't worry about the market tops. Because if you're investing and not trading, not speculating, and investing should be tied to your financial plan. If you're investing, even if that market peaks, over time, the market moves higher and so will your portfolio. One of the nuances is assuming you are properly diversified and allocated. And really, that part's not that complicated, but people have a hard time understanding it and doing it. So we're going to talk about that in a second. These numbers only work if you stay invested. You can't get shook out. You can't avoid markets when they're high. You can't avoid them when they're low. If you're a long-term investor, buy in, buy good quality, stay diversified, well-allocated portfolio, and it will perform over time. So if your financial plan, here's the caveat, here's the point. If your financial plan works, right? You build a plan, you plug in numbers. Okay, my expected return is 8% over time. If your financial plan works with an 8% return, market peaks should not bother you. It's part of the calculus to get you to your financial goals or keep you there, which for most of us should be financial independence. Okay, and that's particularly important for people in retirement drawing off their portfolios. So I always throw this out. If you're not sure, if your investment strategy doesn't tie to your financial plan, you should know that. And if you're one of ours, give us a call. We'll walk through that and make sure you're good to go. If you're not one of ours, same thing. Give us a call. We can do it on back and napkin and help you tie this out. So we also cover this slide every time. And again, it ties out perfectly what I was just talking about not buying or not worried about market tops. This chart, I'm not going through it in detail. I just want you to see the columns and the colors. That's all that matters. It's known as the Callan periodic table, and it represents the annual return. Each column is a year, right? Going left to right. And each one of the square is a different asset class, each one of the colored squares, okay? From quarter to quarter, the diversified portfolio, which is the white square, looks just about the same, somewhere in the middle consistently. It's never the absolute top performer in the market, and it's never the absolute bottom performer in the market, okay? Which means, in technical nerdy terms, it's less volatile than the individual asset classes, okay? Bring it back down to practical. This is why you don't over-concentrate in one area, like tech. We've seen that shift this year. From the beginning of this year till now, tech has got walloped, right? Marshall's 493 versus 7 slides earlier proves the point. There's 493 other stocks that are actually outperforming the tech index now, called the tech index, the tech stocks, the Mag 7, the Mangos, FANGs, all of them. So, and the whole point here is less volatility helps provide a more stable return over time to help ensure your financial plan actually works. Understanding this is especially important if you're already living off your portfolio. You're bringing that cash flow out of there, okay? So, in short, staying invested works best. And it is a lot easier on your nerves than trying to time the market. It doesn't work. It's a fool's errand. When you're diversified, no matter when you invest, being diversified helps. Okay. Don't worry about when you invest. So as always, we'll leave you with this. Ignore the news. I don't care which side you're on, CNBC or Fox, turn them both off. Stay invested. Don't try to time the market. Don't worry about the highs, and stick to the fundamentals. The stuff we're showing you here from the fundamentals of the market gives you an idea of just the world's not on fire like everyone thinks it is. And the fundamentals of the portfolio, if you're allocated and diversified over time, you're going to do just fine. So I know I went a little long on that, Marshall. I apologize. If we've gotten you a few more minutes, I know we have some questions in the chat. So please, let's turn it over to questions.
No problem. We have some items in the chat, but please type your questions in the chat box. We've got a couple of questions typed in. I'll address a couple of these really quickly. One is about IBM. If you watch the market, you may be aware, especially if you're an IBM shareholder, IBM had a pre-conference before they reported earnings. Their stock fell about 25% in one day. They reported earnings and it fell roughly about 5%. So can you imagine a company the stature of IBM, suddenly their stock dropped 30%? This is what we're seeing in the market as the penalty for the tech companies if you don't meet earnings and you don't provide what the market considers favorable guidance for the upcoming quarters. So IBM got hammered. Do I think IBM's 30% dead? No. IBM's a solid company that's been around. They'll get it figured out. They'll work it out. How quickly that happens becomes the question mark. So it's really ugly, especially if you're a large, relative to your total portfolio IBM shareholder. But don't panic. Stay the course. Do your homework before don't do anything drastic. Another question about data breach and LifeLock or freezing your accounts. We always encourage clients to be very protective of their data. We spend a lot of time in training here at the firm on data security because as obviously we have a lot of secure data. And with what goes on in the world, it just scares you to death. But if you feel that you would be better using LifeLock or one of the other providers, or at a minimum going back to the three financial reporters, Equifax, TransUnion, and I forget the other off the top of my head, but you can freeze your credit, but guard yourself very, very closely. Shawn, I hit those quickly. I'm going to ask you to cover a couple of things for us, but if you got anything to add in those, jump in. But you touched on the market and it's peaked. Is the bull market peaking? And what should we expect for Q3 and Q4?
My crystal ball says, ask again. Seriously though, I think we did hit a nice little peak in the markets, if you will. Is it the end of the bull run? I doubt it. I'm totally speculating. I don't know. Nobody knows. But based on the data that we're looking at, based on the increase in consumer spending and consumer sentiment, I feel like this thing's got a little bit more legs. That's what we're hoping for.
All right. We received an advanced question regarding what if other countries, China, for example, stop purchasing U.S. debt? Hey, we're all in this together.
Yeah.
I mean, think about that. If suddenly China, Japan, several of the countries that traditionally buy U.S. debt start doing that, and the American consumer gets in trouble because we've got that issue, the U.S. government's got funding problems, that means that U.S. consumers are going to stop buying goods that come from, guess where? China and Japan. So the old days of silo economies, I think, have really gone by the wayside. We're an international economy.
Yeah.
And what's good for the U.S. is good for China. And what's good for China is actually good for the U.S. You may not hear that in the media by any stretch, but we're all in the same boat. Shawn, you want to piggyback on that in any way?
I do, actually. We were talking, I can't remember what slide I was on, and I kind of went off on a little bit of a tangent and a riff. And, you know, the reality is, if we're just talking straight business here, Marshall, there's nowhere else to go. The safety and stability of the U.S. economy, albeit, you know, our debt to income ratio is what, let's call it an 8. I can't remember my calculation. grand scheme of things, not the end of the world, not that bad. Where else are you going to go? The global reserve currency. We're it. International banks are loading up on U.S. debt and U.S. cash because it's the most stable currency in the world. And until that changes, nothing else is going to change. Market size and liquidity. In exponential scale, the U.S. market is the largest and most liquid market that ever existed. And the next biggest economy is nowhere near it. So until that changes, this is going to be the status. And again, this is why I think it was the debt slide, Marshall. It was the, I like that slide you did. And until that changes, unfortunately, and we need to fix it. I agree, mounting debt is not good. But until all that changes, that's not going to be an issue. And again, the treasuries, we do have an attractive yield. You pointed it out earlier. Where else in the world are you going to get a safe, stable yield in a highly liquid market that you can put in your bank and you can run your economy from? So no, I don't think there's a big chance of risk that. I don't think it's going to happen. If it did, the global economy stops. Period. Nobody wants that.
Which, speaking of, Shawn, you've used the term safe and secure in your sentences there. Recently, there's been a move from the high-flying tech companies. One of our listeners wants to know, would you suggest some non-tech investments?
Is this where I have to put the disclosure in? These are for educational purpose only and not a recommendation to buy or sell.
In multiple, and in all caps, please.
Yes. So we'll go back and edit that and make sure it's all caps. But avoiding specific names, of course. And you touched on it earlier, Marshall. There are 493 other companies, S&P, that are not part of that Mag 7 that we were talking about. But generally speaking, right? Look for certain dividend paying domestic companies. There's favorable tax treatment for that. And even with the volatility of the capital side, right? There's two ways to earn money in a stock, right? That you want the price to appreciate or you get income off of it, dividends. Well, while you're waiting for the price to continue going higher over time, you can earn dividends, that mailbox money, a good friend calls it. So there's a place for a little bit lower risk dividend payers out there. There are stocks out there. So look for good quality companies that pay good quality dividends, that you know the name, that when the next recession hits, you can go look at the fundamentals and you can say, there's nothing wrong with this company. People are selling it off because they're throwing the baby out with the bathwater, and just collect your dividend while you wait. And a lot of those companies, a little hint, you can find them in the Dow. There we go. Marshall, does that answer it, you think? Do you have anything to add?
No, I think we're good. One of our viewers said, do you see any black clouds on the horizon? And what should we expect for the rest of the year? Well, I think, thank goodness we always do this the day after the Fed meeting, because with the Fed's no change action yesterday, I think you should really expect more of the same as we have seen the last 6 months as far as the economy. Barring anything dramatic from an inflation standpoint, we'll continue to see the volatility from the headwinds of the Iran conflict, tariff assessment or withdrawal, judicial decisions on legality, and the election. So more of the same. Shawn, you got any other comments on that?
Nah, you covered it. I think we're good, Marshall.
I appreciate that.
Yes, sir.
Well, let me take a quick look and see if we've got any other questions in the chat box. I don't see any fresh questions there. So to close, of course, I know I apologize and I don't apologize, because we pound this in, and this is such a mantra for us. Always build your investment portfolio with companies whose profits are not tied to politics. And that's a little hard to find, but just make sure you're diversified. Regardless of what happens in the economy, who's in the White House or Congress, people keep using Charmin. I hear they need a lot of that in DC. They keep eating out, taking their prescription drugs, and using their technology. So please remember to follow us on social media, scan the QR code up in the corner, and you'll be linked to all of our resources. To kind of wrap up, if you know someone who would benefit from our webinar, we'll also be offering a recording of today's presentation on the McCabe Gunn YouTube channel. Once it is posted, feel free to we will email a link to all registrants, and feel free to email a link to your friends and family who would benefit. I don't see any final questions from the audience, so Our next scheduled event will be our Q3 economic update, to be held on Thursday, October 29th at 10 a.m., right before the midterm elections. So I'm sure there'll be plenty to talk about. But thank you for joining us, and we look forward to meeting with you soon.